Welcome to Greenings and our series Leaders in Transition, our global webinar for cross-sector leaders. My name is Dennis West, and I'm here with my fellow board members, Chris Turpin and Dimitri Euler. Today, we're going to have a presentation and a Q&A discussion on a key driver of sustainable corporate transitions, standards. We will present to you insights from research and practitioners. We are going to talk to you about the utility value of regulatory standards and opportunities for improvement. As a standard practice, we follow the same format and finish after exactly 60 minutes. So this is our lunchtime seminar that you can enjoy within 1 hour. As an introduction, my name is Dennis West. I work as a researcher at Oxford and I teach sustainable finance and business. I am the founder and board chair of Greenings and work broadly within the intersection of sustainability, reporting standards, organization studies, and legal regulation. Over to you, Chris and Dimitri.
Thank you, Dennis. My name is Chris Turpin, and I am also a board member of Greenings, which forms part of my portfolio of initiatives, projects and organizations that are focused on sustainable change in some shape or form, but certainly all purpose driven. My background's asset management, financial services, so I bring that perspective to the Greenings board.
Hi, my name is Dimitri Euler. I'm in charge of the financial market chapter at the Value Balancing Alliance, where we deal with larger corporations, which in general have a reputational risk, but we also have some kind of smaller asset managers that follow impact accounting and try to invest aligned to impact accounting. So, welcome.
Thank you. Our mission as a non-profit organization is to connect members and partners to work across sectors and to translate their activities into a shared positive impact. We work very hard to work out our vision and our values, and what unites us all, from a senior decision maker to a technical expert, is a view of empathy, of awareness, courage that we bring to the table. And we all ask ourselves, what if the business we're working in could transition faster and more effectively towards a sustainable future? To that end, we engaged in the last 5 years in a number of collaborative sprints, and we developed, according to the research that we do, a model that allows us to work across sectors in a very time-boxed experience. And what we try to do with that model is to now scale this within different sectors and for different solutions and problems that arise on the transition pathway of a business. And as a first challenge, we chose the challenge that is facing many businesses in the world today, to comply, to work out, to make sense of standards. And not any standard, but a standard that we call regulatory standard, that really follows the question of how do we move from high-level policies that are addressed to governments and international communities to very specific decisions in an organization. And this is highlighted by the Sustainability Development Goals we see here, and the Task Force for Climate-Related Financial Disclosures that really tries to translate a particular type of SDG goal, namely climate action number 13, into organizations. So what does that mean for data? Because decision requires information, requires data, and there is a SDG number 12 that has a particular target that by 2030, most companies should adopt sustainable practices and integrate information into their reporting cycle. That is a stated goal that companies and governments pledged to achieve by 2030. Now, a global timeline shows us a mixed journey towards that goal. It starts perhaps earlier, but really formally, it starts with 29, with the Sustainable Stock Exchange Initiative, where stock exchanges came together to convened by the United Nations to understand how could listing requirements and how could reporting requirements within their usual financial disclosure architecture, how could that integrate sustainability and impact data. Then with the years, companies and countries moved on to various legislations, various standard setting initiatives that moved from a really voluntary to a more mandatory nature. And where we stand now is almost like a feedback loop where we ask ourselves, how can this be simplified? How can those standards and this data that is produced be simplified? And the question we are all asking, whether we're in the United States, where the SEC has unfortunately dropped their climate disclosure regulation, and in the European Commission, where there is significant discussion around the scope and the breadth and depth of reporting and sustainability data, where does that leave us? And so just to give you a sense of what do we mean by users when we think about sustainable transitions? We think about users in terms of three elements. How do they use data? How should data be presented to them? And how do we ensure relevance for them? And so those three elements are part of an information user experience. There's a set of characteristics that we ask ourselves, are they met? And what are the qualitative and quantitative criteria? If you'd like to know more about that, two of our board members, myself and Dimitri, wrote extensively about that, and we're happy to share more information over the course of our engagement and the next webinars. But really, when we zoom into the utility value or usability, the current practice is really to think about how effective is information to deliver a certain outcome. How efficient is the information presented for a decision maker to actually really act? And are those users really satisfied by the information? Does the information meet the needs of decision makers? We want to go a little bit deeper into the different standard setting bodies and ask ourselves, how do those criteria match up with how standard setting bodies that are currently very active and in the frame also for their work, how does that match up against their work? So usually what we have here, and this comes out of my own research at the university, we look at the key standard elements. Every standard setting body has conceptual framework and then specific standards. Every standard setting body also engages in some sort, shape or form in capacity building, in market development, post issuing those standards. And then ideally all of this, from the very beginning of the standard development to the very end of standard adoption, there's a due process that everyone follows. There's different due process frameworks, but broadly, it is key to every standard setter that you have a due process. Now, when we zoom into usability, many, if not all of the standard setting bodies engaging in sustainability reporting, they struggle with one point, and that's the criteria of usability. Neither in the conceptual framework stage nor at the end of the market development is it really a key concern in the practice to assess the effectiveness, the efficiency, and the customer or the user satisfaction for an information user. And while due process demands some participation and consultation in each of the standard setting bodies, really research evidence on the user needs is not sufficient. Now that has systemic reasons. Some are market related, some are regulatory, but broadly speaking, the reason why we're asking these questions, who are the users and what are their needs, is really that regulatory standards have an additional component. They become law. They become mandatory for someone. And if someone needs to adhere to a standard, then they also need to accept and adopt those regulatory standards. So what we really think about, when we really think about usability, we really also ask a question about the proportionality, the costs and benefits of reporting. And as I mentioned earlier, the current system is set up in a way that the costs and benefits are assessed from the perspectives of the preparers, those who prepare the information, not necessarily and straightforwardly from the perspectives of users. So there is, in a way, no surprise that we are running into the question of simplification. Now, what are the potential solutions, and how do we get from the challenge to some shape or form of understanding of the user needs? And that is exactly what Chris will guide us through.
Thank you, Dennis. So, I mean, to recap on that, I mean, obviously, any, let's call them top-down organization, regulator, etc., preparer of data is doing so with an objective in mind. They're looking to secure an outcome from the various stakeholders or users that are likely to prepare the data and submit the data afterwards. Data is important across every sector, so we're going to explore users in a little bit more of a kind of tangible way. Every sector out there, from corporates to asset managers, asset owners, etc., has a vested interest in securing high quality data to support their strategic transition planning. And I think there's a recognized challenge here for every sector. They're all different though, albeit similar. Companies, impact is multifaceted, from carbon emissions and biodiversity loss to social outcomes in the communities in which they operate and serve. The data that companies need is often interconnected and often difficult or impossible to disentangle. They all represent opportunities and risks for businesses, and that's how companies will be viewing the information that the data is effectively providing them. So consistent and credible data, accounting methodologies. So here I'm going to be talking about bottom-up source data, impact valuation, impact measurement data, should enable companies to better understand their position in a holistic sense. And by that, I mean across the spectrum of sustainability, opportunities and risks that exist, as opposed to on a case-by-case basis. And by doing that, it should enable them to make better medium and long-term business decisions. So we're talking here about operational decisions, what they may or may not be comfortable doing day to day, in alignment with their overall position as an organization, their value statements, their corporate sustainability goals, but also in line with their brand and any commitments they've made externally. So it helps decision making. It also helps reporting more meaningfully and accurately to their key stakeholders, which is their shareholders, of course, and also the regulators. So up and down, if you like, they have communication obligations. So what that means is within an organization like a company, you've got multiple interested parties. So two things to point out here. Your users here within a company are going to be specific to industry, and they're also going to be specific to the company itself, and they're also going to be multifaceted. You're going to have lots of users in different areas using the data for different purposes, and it's very important, therefore, that data has integrity and that data is sufficiently tangible and useful so that it can be actually put to good use more generally. Putting aside companies, those that own the companies, the investors themselves, particularly institutional asset owners, so pension funds, insurance companies, sovereign wealth funds, etc., typically have very long-term investment time horizons. And so do most of the asset managers, especially the active ones who invest on their behalf. Each of these has fiduciary obligations to their members, their beneficiaries or clients, to deliver superior risk-adjusted returns. They have return-orientated objectives primarily, even if sometimes they'll have a dual purpose associated with their investing that sits alongside. And for investors, better data is absolutely vital to identify and price sustainability-related risks and opportunities at a stock stroke, company level, to compare similar companies on a like-for-like basis using consistent appraisal methodology. You want to be appraising companies' investment opportunities on a like-for-like basis. Methodologies help to do that. And that in turn should help stewardship and engagement. If you understand what kind of risks you're taking in your investment in a company in return for the return you're hoping to get from it, you have a basis for A, engagement, and B, a tool to actually measure progress over time around your engagement. To what extent has the company started to adopt your suggestions and move in a direction in which you're more comfortable with? It also allows potentially portfolio level assessment. So investment managers and asset owners that have portfolios of companies can start to track risks across their entire portfolio. And then in a holistic sense, understand what their portfolio looks like as a whole in terms of risks and opportunities. That's a lens perhaps they might not have been able to apply holistically before, but certainly incredibly useful to understand what opportunities and risks they're actually facing. And for asset owners, of course, they can consolidate portfolios. It's one level above that. But so again, it's decision-making, it's analysis of risk and opportunity, and it's reporting. So again, asset managers need to report to their asset owners need to report to their members. And this sort of investment valuation, measurement, accounting data, the employment of high-quality data, the use of a consistent methodology assists that and enhances these stakeholders' ability to be able to do it. Other stakeholders we might talk about, though, include governments, governments who may have decisions around specific projects that they might want to allocate capital to, and to appraise capital allocation opportunities against stated national policy objectives or international commitments and track their progress. Again, it enables them, using a consistent methodology of high-quality data, to appraise what initiatives to allocate capital to, what risks they're taking in the process, and therefore what's the best allocation that they could possibly make. And finally, I just want to touch on the academic sector. For the academic sector, there's a real opportunity to utilize impact valuation and measurement data as a tool to better connect climate science and general socio-environmental research with real-world risk valuation models and financial decision-making. Naturally, the academic sector speaks a slightly different language to the financial services sector, and I'm not suggesting either of those languages is better than the other, but when two sectors speak slightly different languages, there's scope for misunderstanding, miscommunication, etc. So I think, hopefully everything I've said so far sounds sensible, but I think impact valuation and measurement data supplied with a consistent methodology by a variety of different solution providers, but that sort of data, if used consistently by sector participants, should be hypothetically incredibly useful for a variety of different decision makers within the organizations and also for their reporting purposes. And Greenings, really, to a large extent, is now focused on testing the hypothesis that this all makes sense in practice. So over the course of this summer, we are launching a time-bound sprint to explore the real-world utility value of impact valuation and measurement data through the lenses of the 6 sectors that I've touched on. So corporates, companies, asset owners, that's the pension funds and insurance companies, the asset managers that represent them, commercial lenders who want to assess risk and opportunity, or strengths or pros and cons of lending to different organizations, and investment banks who will, as part of their equity analysis, inevitably want to assess many of these risks and opportunities as part of their own equity valuation models. Law firms too, we're very interested in the perspective from a legal angle as to where fiduciary responsibility starts and stops. Clearly, for investment asset owners and investment managers, there is a primary responsibility to members of generating superior long-term risk-adjusted returns. But at the same time, what role within that do these sustainability opportunities and risks play, and what role can data play in better enabling that and consistent with their objectives? And the academic sector as well, who will inform to a large extent much of the data that's actually being produced by the solution data providers. And the goal of this is pretty simple, really. It's to deeply and better understand how each sector group, each of the above, could use this kind of data in practice. Which departments, which areas will use the data? How will they use it? What will their specific needs be, and what opportunities emerge when these perspectives are then shared across the system? So as part of our sprint, we'll have representatives from these groups at a senior level, so senior individual participants. We'll also have supporting technical partners who'll be involved very much in the day-to-day work on the sprint. And the questions will be at the end of it, what have we learned about the other sectors, each other, as much as what has each sector learned about the usability or the usefulness of this data itself? Because ultimately, the hypothesis that sits behind the work that we're doing is if we better understand the needs of different sectors, and we can empathize with those, and we can all work together to use data in a broadly sensible and useful way, we should be in a better position to be able to realize positive change collectively and aligned with each of our sectors' individual vested interests. So, Dennis, I don't know if that captures bottom up what the role of impact sustainability accounting and measurement valuation data could do and might achieve, but that's my intro.
Thank you very much, Chris. That was a very good intro on potential solutions and from a user perspective. We're going to hear now from Dimitri about some examples. And I'd like to just briefly, just in one sentence, what is impact valuation before we go into the several examples, how it might tie into transition planning as a use case. Over to you, Dimitri.
Well, thank you. Actually, it's good that we start with the question about what is impact valuation. Well, impact valuation is a kind of valuing the measured impact. In other words, when a company has an output of water, that liter can be assessed differently depending on the context. Or when there is an occupational health and safety incident and the person is sick for 6 days, these 6 days may be very different in terms of valuing depending on what demographic it is and what the context in terms of which country it is. So depending on whether the impact is kind of geographically localized or can be global, like a greenhouse gas emission, the valuation needs to consider that context. Therefore, valuation needs to consider the different context of the particular data point, like water, land use, pollution of land, of air, but also greenhouse gas. And for socials, needs to include the demography. If we think about how to value training, how to value living wage, or how to value occupational health and safety incident or forced labor, child labor. There are, of course, additional data points we can think of. But so in a nutshell, it is the measured impact times the value factor that is context specific. So when it comes to water, we're not speaking about one value factor, we speak more about a value factor matrix, which is contextualized. So we speak about a lot of value factors. So this is impact valuation. So we call it sometimes impact measurement and valuation. And if we speak of the system, we speak about impact accounting. Does that answer your question, Dennis?
Thank you very much. Yes, and we will have also a Q&A discussion with some of our other partners who are here in the room. And before we do that, let's go into how two examples show in a very, very simple way what did you do in those examples and what was the outcome, and then at the end sort of a bit of a reflection on what's next for the transition valuation project in particular.
Yeah, thank you, Dennis. So corporates in general, they have already system in place where they account for greenhouse gas. But when it comes to the valuation of greenhouse gas, some of those scenarios they applied are only tied to kilowatt hours, for example, the IEA net zero scenario, but you can go broader. For example, when you think of NGFS, I call that the motor of an NGFS scenario or IPCC scenario, which is SSP 1, 2, 3, 4, I think up to 6. So these scenarios, they can be modeled depending on different algorithm or different motors. So actually, when it comes to a central bank scenario like Remap Magpie, they consider already water impacts and land use implications in addition to GDP and sometimes poverty alleviation questions. So for us, dealing with impact statements of our corporates, which actually track more than just greenhouse gas, track air emission, water pollution, water consumption, land use, and maybe some other resource uses, it was kind of interesting to understand how will the impact statement overall, not just for greenhouse gas, actually will change. So we took just three data points, which is greenhouse gas, tax and occupational health and safety, and thought about how will the indicator change depending on three NGFS scenarios. So this was the S1 net zero 2050, then the delayed transition and the current policies. I mean, there are others which we did consider but are not shown here. And you see that, you know, the greenhouse gas above was -100, and then depending on the scenario, it changed in the S1 to -114, -180, or -507. And what was of interest is actually that you see that for the tax scenario, the taxes are paid by the corporate and they went up, for example. And this is kind of, you know, the positive impact of a negative outcome that, it is good for under some circumstances, the state will receive more than just what they do. I mean, in a current policy scenario was 111 and a delayed transition 111, whereas, you know, in net zero 2050, which was the best for greenhouse gas, was the worst outcome for tax. And then we see that for occupational health and safety, I mean, there were not that much, you know, the implications for this particular company. This could be, you know, because the company deals at places where, you know, the differences are not that big. But for example, when you think of a production in India, and there the heat, the temperature and temperature and humidity reaches a certain level that you have situations like in a sauna, that you can imagine that, you know, immediately you will have a lot of occupational health and safety incident depending on the different scenarios. So this was interesting for our corporate, because what you see here, that none of the net zero scenario, even the best one, actually will not reach to the target under their transition pathway. You know, so for us, these are kind of the new questions that you somehow need when you when we think of what are the next steps. I mean, you think of a transition pathway, so you need to consider how your greenhouse gas will change and how the valuation will change, and immediately how the other indicator like water consumption and occupational health and safety incident will change as well, because just getting from a as is a scenario from today and, you know, do the whole anticipation in future will not lead to the best outcome, even if you take, you know, the best situation under the NGFS scenario. So that's why let's go to the next example. We thought we need to have more clarity in terms of how impact is, you know, assessed and combined, and we started also about, you know, maybe it is not just about the absolute values of where you go to. We want to understand also how is the corporate actually performing within a certain group, whatever the group shall be. And here we realize that we do not know a lot about it. So actually what you see here is a kind of the next step. It is a SASB benchmark for transportation. And we did this for all the SASB sectors. We also did this for countries and all the NACE sectors. So you can get a lot of, you know, insights, and you can compare. And we said we want to organize that corporate in that manner that we want to understand the different the different impacts for the different tiers, which is own operations, then your supplier, where you have a contract, then maybe the supplier of your supplier, where you have a guarantee, and all the remaining value chain suppliers. So we want to understand your overall impact for greenhouse gas, air emissions, water, waste, land use. Here you see invasive species and ocean plastics. So to understand when you compare yourself, I mean, how do you perform?
And Dimitri, what is next? How do you take that to the next step?
Yeah, what we realized then is that we maybe find a quantitative way on how to assess the impact, but we need to find also a quantitative way how to set thresholds. And it is not sufficient that we, just quantify the impact in terms of a model, and then you need to use this data, and then go to an expert and ask him, "Am I material?" Because the question remains is, you did all that quantification work with a lot of science, but you now just ask a subjective opinion about the person on whether they reach the goal. And you imagine this may work, if you are a small SME and only work in Geneva, and your supplier is only around the corner in Annecy. And so, I mean, the whole system is the same. So maybe it works, you only have to ask one expert. But imagine you are a global company, which actually is operative in Malaysia, Indonesia, and in Singapore, but also in the UK and in Germany, and maybe in the US and Brazil. I mean, you need to have an expert for all the different data points, which could be potentially material. So you end up with a bunch of different subjective data. So the question was, and there, Dennis, we did in our last trip some kind of an assessment on how can we quantify a threshold or establish a threshold that takes care for the specificity of the different data points, like the context, but also puts then the threshold in the different context of comparability within the indicators, countries, but keeping the unique character of the data point in the valuation. And that is something where we still work on. We realize that we have still a long way to go. You can imagine if you take, for example, a risk approach, what you do is you take the damage and you divide it by revenue. But I in particular take damage. So if your damage is 10% of your revenue, that may be material for you. But can you do the same with a monetized impact? Like you have a monetized impact in terms of money, and you divide it by revenue. I mean, it may be fit or maybe will not fit the purpose of your assessment depending on the data point. So we don't know that. So we still have a lot of work to do. That's why we need such sprints to better understand how can we set a meaningful threshold considering a quantitative assessment of impact as well. So it's not just the quantitative impact approach, it is also the quantitative setting threshold approach, and put the stakeholder, the expert, in a review position.
Thank you very much, Dimitri. Thank you very much, Chris, for this valuable contribution. I will move to the discussion Q&A session. Usually this part in a webinar Greenings is not recorded. By way of conclusion, I will not do justice to all of the discussion points and that came after the presentation, but I want to highlight and summarize a few points that we are seeing both from the research evidence, but also from our practitioner conversations. So number one is this term decision usefulness, which is very core to, similar to materiality, the principle in accounting, is surprisingly poorly understood in both accounting, traditional financial accounting, and sustainability, where we get that information about decision usefulness or about the user needs. That's mainly from solution providers who are very close to the customer. to the users of that information. So almost the intermediaries between the standards and the actual users of those standards. Number two, innovations in accounting. And I see this broadly speaking, also impact valuation. Capture corporate impacts, and those are really complex. That's a different animal or a different kind of information than financial information. The impacts of a corporation on society and the environment are just by nature complex, and also that's what my point was in the discussion was by nature it is a diversification of users, and that means dispersed market structure. And we see that also in terms of how the market for data is evolving. Now, number three is a point more specifically to what we mean by usability. And again, by way of just summarizing in the discussion, it means that we should understand user needs from their perspective. And that means to go into really deep and deep understanding and deep engagement with those constituents. And while that may be costly, it will be in the long run enable everyone in the ecosystem to simplify, but in a way that is not too simple. Number four, again, if we think about those user needs, then they are defined top down, and mostly from the perspective of those who are engaging and have the resources to participate in the standard setting process in the first place. Those are auditing firms, large multinational corporations, and technical experts, well, from the global north. Now, as we say, if we accept the assumption or the notion that impact data is demanded or required for a diversified, very big community, different community of users, then we ought to go beyond those narrow notions of how we assess usability. And finally, the fifth takeaway is a bit of a call to arms. Is more, one way of looking at sustainable transitions is we have an agenda that is globally accepted by 2030 with 17 sustainable development goals. We have 168 targets that underpin those goals. We have even more, 250 plus indicators that should measure those targets in achieving those 17 goals. And we are 5 years into, 5 years to go to reach that time frame of 2030. There will be an ongoing, on the policy level, an ongoing discussion of how to extend those SDGs and the horizon when we meet them. But we can all agree that we need change at pace and at scale. And that's why the Transition Valuation Project is really addressing the issues that we identified above, together with asset owners, solution providers, and other relevant users in a new collaborative sprint model. And I would invite all of you who are listening to this webinar, whether live or the recorded version, to join us on this journey, join us at various stages in the timeline. And if you'd like to get more information, we are all very open for conversations, and we will welcome you to the next monthly webinar, which is always on the Wednesday, the last Wednesday of the month. It will be in May, and we will have one during London Climate Week, which will be a hybrid event in person and online. If you are more interested in learning more, visit our website. We will have more information and increasing resources and assets to download over the next months. Follow us on LinkedIn, become a member. It's a free membership for the rest of the year, and we will focus on individual memberships. Become a partner or simply contact us on the collaborate@greenings.org.